Well, good morning, everyone. Welcome to this workshop about taxes. It's very popular, so I'm not going to take up a whole lot of time because I am not your presenter. My name is Jessica Holland. I am with South Arts. I'm the Director of Organization and Community Initiatives. I am calling in today from the land of the Cherokee and Muskogee Creek, otherwise known as Atlanta, Georgia. Joining me today is Karonda Baker, who is the Assistant Director of Programs, and Elaine Grogan Luttrull, who is our presenter. And also, I'm going to do a pitch for you, Elaine, and I don't want to embarrass you. And she didn't pay me to do this, but I love this book.
They have, but that's her choice. That's her individual choice. That's mom's choice.
If you could all mute your microphones, that would be super helpful for your fellow colleagues. If you want to come off mute and ask a question, we may have those times throughout. If you didn't see this because it's blurred, this is called Art and Numbers, and I'll send a link to you through Goodreads as well. I recommend it. It's a great read. Before we begin, I just want to give a little thanks to our funders. And this program is brought to you by the National Endowment for the Arts. And a super thank you to our leadership team, our CEO and President, Susie Circumer, and my boss, Joy Young, Vice President of Programs. All of those are supporting this program today, although they're not here on camera. They're here behind the scenes. Also, hopefully joining me, if he's not here yet, is Emmett Stevenson. Emmett is typically our go-to for artist resources. I know he was having a little bit of trouble earlier logging in.
I'm here.
Yeah,
Jessica, I'm here.
Good. I can't see.
Good morning, everyone. Good morning and welcome to this workshop. We hope that it is definitely advantageous to you in planning your taxes. So please enjoy and let us know, give us feedback when you are able to. Thank you.
Thank you, Emmett. And Emmett is my team member who helped make this possible as well. Hopefully without any further ado, I am going to turn it over to Elaine to lead you through a tax journey for 2023.
Good morning, everyone. A tax journey for 2023. I totally love that. It is absolutely my pleasure to be joining you today. I have shared my screen. These will be the sort of visual cues we'll walk through as we share this time together. And there's a copy of this posted on the event page. So if you want to download this or take notes or refer to it later, by all means, please feel free to do that. As Jessica said, our goal today is to support you on your 2023 tax journey. We want to make navigating tax season this year and in the future, hopefully a little bit easier for you. More specifically, we're going to spend some time going over kind of the overall income tax landscape and sort of going a little bit back and forth between business taxes that come up for your art practice and also personal tax benefits you might want to take advantage of. We'll also spend some time talking through those ordinary and necessary business expenses and what those look like using some examples. And then we'll call out some effective record-keeping systems and practices that might help support you for this tax season and those in the future. As Jessica said, I'm Elaine. I use she, her pronouns, and I am joining you from Dublin, Ohio, just a smidge north of Columbus, which is Kashkoshki and Hopewell Indigenous and Cultural Lands. And by training, I am a CPA, but all of my work is with creative individuals and organizations. And I have the great pleasure of working with amazing organizations like South Arts and funders and colleges and universities and other state arts councils and commissions across the country, making me pretty much the luckiest CPA anywhere ever. Having said that, all of this information is for educational purposes only. I am not giving you tax, legal, or accounting advice because, as you see, there will be some nuances to some of the things we'll talk about. So just know that this is an educational workshop, but I hope it is still helpful for you. So let's start with sort of a big question. How do federal income taxes work in the United States? If you are a permanent resident, a dual citizen, or a U.S. citizen, you are probably used to filing Form 1040. That's the main income tax form for individuals in the United States. If you fall into a different category, you might have a different form, or you might not have any tax filing obligation at all. The IRS has some really helpful information on what they call international tax matters on their website. But the focus today is going to be on folks who are permanent residents, dual citizens, or U.S. citizens who are familiar with Form 1040. And Form 1040 starts by asking for income you have earned, right? And for some folks, that is a very easy question to answer. They have one job for one employer, and that's all that they're doing to earn money. In the arts, we know that that is not our reality. So how you earn money becomes pretty complicated, and that complication shows up on your tax form. So how you earn money determines where income gets reported geographically on these forms. And in general, you are probably earning income from wages if you have what we call a W-2 job. So you have some sort of employment for someone else. You also probably have business income or income related to the creative business you are running. And you could have some other income as well, maybe real estate income or investment income, disability income. You could have other types of income that might show up in different places. But if you are someone who has a W-2 job, you earn income from an employer, that income is showing up on line 1 of your 1040. It is probably the least interesting place for it, but it is a common place that affects most individuals in the United States, although not always those in the arts. If you have a job for an employer, your employer is splitting Social Security and Medicare taxes with you. So they are withholding 7.65% to cover your Social Security and Medicare. And then they're also withholding enough to cover federal taxes, but then state and local taxes as well, if you have those. The other big thing to know about W-2 income you might have is that you are not allowed to claim any deductions associated with that income. So let's pretend you are a creative professional and you teach part-time, maybe as an adjunct instructor. And let's say maybe during the pandemic, you were asked to teach from home. And so you bought some new supplies, maybe another charger, some lighting. Any of those expenses are not deductible to you because they are associated with your W-2 job, right? So if you are an employee of someone else, any expenses you have as part of that job are not deductible. That's a big deal and something to definitely pay attention to, especially if there's some overlap between your W-2 work and other work you might do. And speaking of that other work you might do, if you are running a creative business, you probably have some other types of income as well. You might get grants, you might receive awards or fellowships, you might receive 1099s if you are providing services or maybe doing occasional sort of freelance gigs, and you might be selling work directly to someone. Maybe you are selling paintings or prints or photographs, or maybe you are charging individuals fees. Maybe you are a musician and you are offering lessons out of a home studio. So you're collecting tuition payments from people. Those we would all put in this kind of sales category, either of goods or services. You're not going to get a 1099 from your customers or your students, but that is still income to report to you because it's associated with your business. So any of that business income is probably going to show up on something called Schedule C. That's the form you use if you are a sole proprietor or the only owner of a limited liability company. If you have an S corporation or if you are part of an LLC that has multiple owners, you're probably reporting numbers on Schedule E instead of on Schedule C, and there's probably an extra tax filing as well. But in general, most of these same kind of things apply. In these situations, for your business income, you are playing the role of employer and also employee, even though we don't always use those words. So that means you are responsible for the entirety of those Social Security and Medicare employment taxes. That's that 15.3% that sometimes surprises people. Remember, if you have a W-2 job, you're sharing that obligation for somebody else. But if you are running a business, you're paying all of it yourself, right? So that's another big distinction, in addition to the distinction of being able to claim business deductions if you are running a business. So let's talk about this idea of running a business, because it seems like it should be an easy question to answer, but it actually gets pretty complicated as you get into the weeds. And often this is a question that comes up for folks if the IRS has some extra questions about your tax return, right? So let's talk about running a business. In the eyes of the IRS, you are running a business if you do a handful of things. And the first thing is, do you approach it professionally and keep books and records? So approaching it professionally could mean anything from having a business plan, having a website, sort of leaning into the more businessy side of your profession. And then that books and records piece is pretty important, because if you are doing something just for fun or as a hobby, right, you're probably not tracking your income and expenses. But if you are running a business and approaching it professionally, you are probably keeping books and records of some sort. So I want to take a quick sort of sidebar to dive into this idea of books and records, because it becomes pretty onerous and it can be really confusing. The IRS says you can use any system suited to your needs that shows your income and your expenses. And here's where I'd like to kind of remind you that you know yourself best. So the idea of building a system that works for you instead of forcing yourself to use some other system is probably a good approach, because again, you can use any system suited to your needs. So know yourself and know how you work best. Within that system, we want to make sure you are capturing a few key pieces of information for every transaction. We want to make sure you know the date of the transaction, the counterparty, so who did you pay or who paid you, and the amount of the transaction. Those three key pieces of information are pretty easy to track, right? They show up on your receipts, they'll show up on your credit card statement, maybe your bank statement, right? So those three key pieces of information are pretty easy to retain. But the fourth piece of information that you want to make sure you are capturing is the business purpose of the transaction, right? That business purpose is what you have to proactively supply or track in your books and records. This is where you would describe the expense and how it is connected to the type of work you are doing. That's the business purpose. So for example, let's pretend after this, Jessica and I are going to go out for lunch and we're going to talk about the tax workshop, right? By talking about the tax workshop and by demonstrating in my record keeping system that on January 26th, Jessica and I went out to Jessica's favorite restaurant, which is going to be the vendor, and spent $75 on lunch to discuss feedback from the tax workshop, all of a sudden, what might otherwise be a lunch with friends is turning into an ordinary and necessary business expense. And I am making sure I am documenting that business purpose so that it is clear that this is not a personal expense, which is generally not deductible. It is, in fact, an expense related to my business. And capturing that information in whatever kind of record keeping system I use is a good way to do that. So what kind of systems can you use? Remember, any system suited to your needs. And the first option is to use basically a database system. This would be something like Google Sheets or Excel or Numbers. These are software systems that look like databases, and they're really useful for tracking and organizing financial information. If you are comfortable using one of these systems, you can manually enter information, type it in, or you can export data from your bank or your credit card and sort of drop it into a database system. And then you can add the extra information you need. For example, that business purpose. It's not going to be on your credit card statement, but all the other useful information will be. I really like these database systems because they are accessible, relatively easy to use once you sort of master the basics, and you can use the information there to do some planning scenarios. For example, let's pretend you're applying for a grant and you did this project a couple of years ago, but you don't remember kind of exactly what the supplies cost, for example. You can go back through this database system, do some searching, maybe run some reports, and then use the information that you've got there to do some planning scenarios and create a budget for something new you might be doing. If you say, yes, I want to set this up, I love Google Sheets, right? Here's probably how I would set up your database system. This is pretty simplified. You can add a whole lot of layers of complication, but at a minimum, this is what I would be capturing. And you'll see you've got the 4 key pieces of information: the date, the counterparty, the amount, and the business purpose of the transaction. And then the extra piece I've added is this column that says category. And this is where I would match whatever you put here with where it's going to go on your tax form. That way, at the end of the year or quarterly or however often you are updating this information, you can sort the information and then make filing your tax form that much easier, either for yourself or for an accountant or tax preparer you might be working with. If you say, Elaine, database systems are not for me, I hate Excel, it makes me anxious and uncomfortable every time I look at it, then you might be more comfortable thinking about some sort of software system. QuickBooks is sort of the gold standard when it comes to accountants. So if you're working with someone, they might prefer that you use that. Xero is also fantastic. So is Wave. People really love Wave. I work with a lot of individuals that really, really enjoy Wave. FreshBooks is also fantastic, particularly if you're sending out a lot of invoices to clients. But all of these systems are going to basically automate the data entry piece for you. And then they're going to make some guesses about what category might make sense. Now, you still have to check in with it. You still have to change the categories if they are not correct. And you still have to do some work, but a lot of the automation is done for you. I also work with folks who might use something like Mint. Unlike some of these others, Mint has a free option. So if you want to set up a username that's associated with your business and use Mint to track business expenses, I've seen some folks do that. Mint is usually intended for personal financial tracking, but you can get creative with the category names and use it as well. Personal Capital is also great. Some people really love YNAB. That stands for You Need a Budget, right? So there are plenty of options out there if you want to lean into a software system. But remember, you can use any system suited to your needs that tracks your income and expenses. So you can monitor everything yourself and do a little bit more work with a little bit more control. You can outsource it. You can even go back to sort of ledger paper and pen and paper, and that is perfectly fine too, as long as it suits your needs and shows your income and expenses. And these books and records, you want to hang on to them for about 7 years. And we get that number based on the statute of limitations, which is the amount of time the IRS can examine your tax return and ask questions. The normal statute of limitations is 3 years, but it can be extended to 6 years if there's something called a gross misstatement. So a large enough error on the tax return that you might need more time to examine it. So we usually say, okay, to be safe, we're going to assume we're going to have a 6-year statute of limitations, but that 6 years only starts on the later of when you file your tax return or when the tax return is due. So that means if you are about to file your tax return in April of this year, and you have an expense from January of last year, that expense is showing up on the tax return you're filing in 2023, that tax return or that statute of limitations starts when you file the tax return or when it is due, whichever of those is later. And then it goes for 6 years. So that's why we say save everything for 7 years, and then you'll make sure to cover yourself for that statute of limitations. And if you're counting years, that means you're going to save everything through April of 2029, which seems impossibly far into the future. I will pause here because there was a lot of record keeping stuff there. Karanda, are there any questions in the chat you want to make sure I address right now while we're in kind of record keeping mode?
Yes, there are. Thank you for that, Elaine. One question regarding that is, would a notebook journal entry pass as a business purpose record?
Yes. Would a notebook journal entry pass as a business record? So yes, if you keep a notebook and list all your income and expenses, that absolutely counts as a system in the eyes of the IRS. Now, if it were me, I would also save those receipts, right? Or some bank statements or some credit card statements. You don't have to, you can get away with not saving them if you have a system that captures everything. But having that external kind of corroboration for what you're writing in your notebook gives it a little bit more authority. So the IRS knows you're not just kind of writing down things. So yes, that absolutely would count as a system if it works for you. And I think that's great. And also the notebook you're buying would be a deductible business expense because it is an ordinary and necessary supply for your business.
Fantastic. Another question is, do you have any thoughts about Quicken versus QuickBooks? There's some people that use that and didn't see it on your slide.
Yes, I didn't list it because Quicken was technically for personal instead of business, right? They're both owned by Intuit, but I love Quicken, right? And just like for any of the other personal systems, you can define your own categories so that you can basically show sort of personal meals versus business meals, right? So if Quicken works for you, it is awesome. Keep using it.
I believe that we're all there for tracking. We do have a question just about people being in, potentially different states or getting income from different states. So as you move forward, I think you might go back and I'll save some of these other questions for that a little bit later.
That sounds perfect. I see one hand raised too. Deanna, would you like to come off mute and ask your question?
Sure, I just have 2 questions. When should you file a business name? When you know you're gonna be a business in the early beginnings, or because the reason I ask, because my tax accountant said that there is a creative, he filed the business name, he was doing all this work, but he didn't get paid. So they had to shut it down. So when should a person really go down to the city and just file a business name? That's my first question. And my second question was, I did print your slides. On that one slide, there was for the database system, there were like 3 little signs. I didn't know what those were. I didn't know what those were. I think one was Excel and the other one was something else.
You're exactly right, Deanna. One is Excel. This is Numbers, which is Excel for Mac users, although Mac users can still use Excel. And then this is the symbol for Google Sheets. Those tend to be the 3 database systems. So great question. When it comes to kind of when you file the paperwork to start your business, it would be when you feel like you are meeting these things to run a business. You're approaching it professionally, you're spending time on it and enough time to make it profitable. You have the knowledge needed and you're making money from it. So in the example of your friend, it might have been a little premature if, maybe it took a year, 18 months, maybe even longer before the income started coming in. That can be challenging. But I would say whenever you feel like, yes, this is a thing, I am doing it, and there's some sort of plan rooted in reality to sort of affirm that, yeah, money is going to start flowing in both directions. That feels like when I would go ahead and file the paperwork to form the business. And remember, depending on where you are, you may or may not actually have to file that paperwork to form the business.
So if you start like a print on demand, like through, I don't know, Zazzle or Redbubble or something like that, should you just automatically just go on and start it?
I probably would. Yeah,
Okay. All right,
Yep.
thank you.
of course. Another question from Jillian. Yeah, Jillian, would you like to come off mute?
Hi, I was wondering if it made more sense for, like, if you are the only employee of your LLC, does it make more sense to file quarterly or yearly? And are there penalties for filing, for not filing quarterly? And then the other part of my question, give me 1 second, I had typed it in the chat.
Oh, yeah.
Let's see if I can find it. Sorry, I think there's a lot of messages there.
There are, and I will say Karanda is hanging on to them to make sure that we will get to all of them kind of when it makes the most sense. So I promise we will make sure we get to it.
Okay.
With respect to filing quarterly, if you're talking about federal income tax purposes, so filing those quarterly estimated tax payments, we generally start if you're going to owe $1,000 or more when you file at the end of the year. So that tends to be the trigger that encourages people to start making those quarterly estimated tax payments. But remember, your state might have a requirement that says you need to file more often than that. It's also possible that for sales tax, which is totally different, you will have to file that more often than just once a year. But
Okay.
yeah, and then we'll make sure Karanda gets to your other question in the chat as well.
Okay, thank you.
Of course. For these record keeping things, right? My general suggestion or invitation for you would be to book some time on your calendar to do this, because it's easy to sort of let it get away from you. I love taking some time once a month. Usually about 2 hours is enough to categorize expenses, follow up with people that might not have paid their invoices, right? Maybe do some planning or analysis, right? So about 2 hours once a month feels like a good rhythm. I also work with a lot of folks for whom quarterly checking in with these numbers is perfectly fine. That doesn't mean quarterly filing taxes like Jillian was talking about, but quarterly going into your system, updating expenses, all of that. That rhythm might work better for you. I also work with people who do it more on a project basis. Maybe you're a musician and you're touring and you want to check in with your numbers at the end of each tour, right? That is also perfectly fine. So find the rhythm that works for you, but it really does help to stay on top of this instead of letting it accumulate for the entire year. And for me, it also really helps to have a separate bank account or at least a separate credit card that you're using for business expenses, because then you know all the data is at least in one place. So that's the kind of end of our record keeping sidebar. So remember, in the eyes of the IRS, you are running a business if you approach it professionally and keep books and records. And then if you do some of these other things as well. The IRS wants to make sure you're spending enough time on this activity to make it profitable. It doesn't have to be full-time, but it does have to be enough time to make it profitable. So if you do one project once, that's probably not going to rise to the level of regularly conducting the activity. But if the work is seasonal, or maybe you are regularly conducting the activity on an ongoing basis, that is perfectly fine. The IRS also wants to make sure you have the knowledge needed to make it successful, which includes creative knowledge, but also knowledge about taxes and records and marketing strategies and those other things. So attending workshops like this demonstrates that you are in fact running a business, right? You are approaching it professionally and seeking out the knowledge needed to make the business successful. Other things that can help here is maybe you work with a bookkeeper or a business coach, or maybe you have a group of peers and you get together to sort of share best practices with each other. Those are all things that demonstrate you are building and have the business knowledge needed, plus any sort of press coverage of what you're doing, any reviews, any write-ups, right? All of that helps support the idea that you have the knowledge needed on the creative side to make the thing successful. That's not required, but that would be how you would help demonstrate that. And then the last thing, if you are running a business, it really helps if it makes money, right? If someone is compensating you for this thing you are doing. It helps even more if you are depending on this business for your income. Now, in the arts, that is very rare. We often have income from a lot of different sources. But if you are making money from the thing, especially if you're depending on the money you're making from the thing, that helps support the idea that you are, in fact, running a business instead of doing something just quote unquote for fun or as a hobby, because there are different tax rules when it comes to hobbies. And you may have heard that the IRS has something called a rebuttable presumption. So this means the IRS will assume you are running a business if you show profit. So positive net income after you've deducted all of your expenses. If you show profit in 3 out of every 5 years, the IRS will assume you are in fact running that business, which is great. That is super helpful. Also, we know in the arts that that's not always how the cash works, right? Especially coming out of a handful of years like we've had. So if you are someone that is running a business, but has not shown profit in 3 out of 5 years, you can probably guess that the IRS is going to say, hey, are you sure you're running a business? Because you don't kind of meet that automatic threshold without showing a profit. So that means you go back to these things and then you demonstrate to the IRS, if they ask, that you are doing these things to be classified as quote unquote running a business. So approach it professionally, keep those records, stay organized, pursue income opportunities. In general, do all the things you're doing and think about evidence that might show that, right? So if you're running a business, and we're assuming most of you are or will be in the near future, you are probably filing Schedule C to show your business income and expenses. And Schedule C has a box at the top that says enter code from instructions. This is where you tell the IRS what type of business you are running. This is your standard industry classification code, and they are all listed in the instructions to Schedule C, usually on like the last 2, sometimes 3 pages. It's teeny tiny font, so give yourself time to zoom in as appropriate, but these are the industry classification codes. I've shown the most common ones I see here on the slide with 711510 for independent artists, writers, and performers being the most common one I see. And that is pretty broad. But remember, just like Deanna was saying, if you live in a state where you do have to register your business, or if you have formed an LLC or another type of business, you have probably chosen an industry code for your state or your city, depending on where you had to file. So make sure those codes match, right? Because it's the same business you're running when you're reporting for tax purposes and to the state. Oh, thank you. Sorry about that. I'm not sure how I got muted, but thank you for catching that. You're running a business. You've gotten your industry classification code, right? Now we want to know what business expenses are deductible. And so we know, or we can take a moment to define that an expense is deductible. Sometimes we'll call it a deduction or a write-off if you are permitted to use it to reduce your taxable income. So you've got your business income, then you've got your deductible expenses, and that gives you your taxable business income, right? So what we're doing is reporting expenses that reduce your taxable income. And here's the general rule. Business expenses are deductible if they are ordinary, necessary, and effectively connected to your trade or business. And so ordinary means common and accepted in your industry. And remember, you've chosen that industry classification code, so the IRS can sort of use algorithms and data to kind of see what is common and accepted in your industry. Necessary means helpful and appropriate for your trade or business. These are terms with some nuance associated with them, especially for creative industries and creative trades or businesses that have expenses that might not seem like their business expenses in other industries. That's why keeping records that demonstrate the business purpose of the expense is really helpful for you. So you heard my example earlier about Jessica and I having lunch. So personal expense, not deductible, but if there's a business purpose, that expense would generally be deductible. This comes up in lots of other contexts as well for expenses in the arts that may not feel like deductions in other industries. The most common one is attending events that might feel like it's a celebratory social event for someone outside of the industry. But if you're in the industry, attending shows, attending exhibitions, attending talks, right? Those are all business pursuits for you, right? So we want to make sure we're clear on kind of how it's effectively connected to your trade or business, because to an outsider, it might just look like a social expense. This came up also for someone I was working with in the theater industry. They had gone to Target and had purchased some plants and a table and a tablecloth and other pieces that were used in a set, in a performance piece, right? So for most people, when they go to Target and buy home decor items, those are personal expenses. But for this person, all of those items were used for a production, right? So that's the sort of thing you would want to document because you want to make sure it looks like a business expense as opposed to something personal. So we've got lots of examples because there is a lot of nuance there, right? So let's start with some car-related costs, right? And I will say, if you have specific questions about expenses, throw them in the chat. Karanda will keep track of them all. We've got a lot of expenses I'll walk through, and then we'll talk through any ones you might have more questions on at our next kind of pause. So car-related costs. Let's pretend you are driving your personal vehicle to and from an event kind of in your town or in your main place of business. You filled up with gas, you paid a toll en route to the event, right? And then you paid to park at the destination. The question is, are these costs deductible? So in general, yes, the toll definitely deductible, parking fee definitely deductible. And then when it comes to gas versus mileage, we choose how we want to take that deduction, right? So for most folks, they track the business miles they have driven and multiply that by a standard rate defined by the IRS. And that rate will then cover gas, insurance, maintenance on the car, et cetera, et cetera. You could track all of your gas expenses and then take a percentage of them, the percentage that was business gas versus the percentage that was personal gas. But for most people, it's easier to just track the miles and use that standard rate. Those expenses show up on Schedule C on line 9, and we want to make sure you're documenting the business purpose of those miles driven. The IRS requires you to have a written log of these miles. So there are some apps that will help you with this. Mile IQ is an app that people love. It will track your business miles driven. You basically download it, enable it, and then you swipe each trip left or right to kind of categorize it as a business trip or a personal trip, and then it will track your miles that way. If you use QuickBooks or another software system to track your income and expenses, often they will have an app to track your miles as well. Or if you really like Excel, you can also just track everything in Excel or Google Sheets. You'll need the date of the trip, the number of miles, and the business purpose. And then at the end of the year, you add up all of your miles and then you multiply it by the standard mileage rate. For 2022, we adjusted the rate in the middle of the year. June was a long time ago, but gas prices were crazy high. So the IRS adjusted the standard mileage rate in the middle of the year. So for any miles you had before June 30th, you can deduct 58.5 cents per business mile driven. And then after June 30th for 2022, it was 62.5 cents. Question from Christina. Yeah, related to car expenses.
Yeah, well, I have two parts actually. So I just recently did my taxes for 2021. I was so late because I was like, I'm a creative, I don't know how this works. And I put business expense for my car, but I'm just wondering, can you go a little bit further? Like if there's any issues with your car, because you're still using the car to, I'm a sculptor, so I use it for maintenance and logging stuff to different locations and, things break down. I'm just wondering, is that also an expense that you can use? And my second question is, I'm in grad school and I also have a creative business and it's related, the degree is related to my business. And so I'm wondering, is there any expenses, for school or anything that I can also use as a tax write-off?
Such a great question. I'm going to answer the second one first. No. If you're not in grad school and doing sort of like professional development, those types of expenses are deductible. But if you are pursuing a degree in your current industry, not deductible as a business expense, although there are some tax credits for education that show up as personal tax credits that you might be eligible for. So dive into that. But the other question around maintenance of your car, this standard rate is meant to cover gas, maintenance, and insurance. So generally, if you're using the standard mileage rate, we wouldn't also deduct additional maintenance costs because that would kind of be like double dipping, right? But let's pretend you have a year where you have really expensive car maintenance. In that year, maybe you say, I don't want to use the standard rate. I want to track all of my car related expenses and then separate out this many miles were for business, transporting sculptures around, going to events. This many miles were from going back and forth to campus, not deductible at all. And this many miles were for going around town or personal things that I was doing. Then you could take the business percentage times all of your actual expenses. And you might find in a year, if you had some expensive repairs, that might give you a larger tax deduction, but it is a lot more work. So you might say, oh, totally not worth it. I'm just going to use the standard mileage rate and go from there. Now, let's say at that event or, moving around or whatever you might be doing, you accidentally get a parking ticket. Parking tickets are not deductible. I'm sorry. Even if the reason was your business thing went so well, you had to get the parking ticket, still not deductible. That is one of my favorite questions that comes up for cars, not deductible. But what if you're not sort of going around the place where you live? What if you're traveling, which in the eyes of the IRS means going away from your tax home, the place where you live and do business, for an amount of time that generally requires an overnight stay? Are those travel costs deductible? So maybe you're invited to attend an event, you've got airfare, maybe you pay to check your luggage, maybe you pay extra if you're a musician to check your luggage in a way that it won't get lost or damaged. Maybe you upgrade the seat on your plane so that you can be a little bit more comfortable. You've got lodging, and maybe while you're there, you go see a show, you pay to see an exhibition. The question is, are these types of costs deductible? And the answer is yes. I would say paying to see an exhibition doesn't feel like travel to me. That feels more like research or something you're doing related to your profession, as long as there's a business purpose there. But all of these other things count as travel expenses. So that lives on line 24A on Schedule C. And the primary purpose of the trip must be business related. So let's pretend your best friend is getting married. You're going to travel to the wedding. And then while you're there, you're going to take a meeting and maybe meet with a curator or a potential host for something you might be doing, or a publisher you really want to work with. One meeting cannot turn the entire trip into a business trip. The primary purpose of going to your best friend's wedding is personal, right? So make sure you are clear on the primary purpose of your trip being business related. Yeah, Danielle, question about travel?
So I actually have a question about what you just said. It's kind of a very specific version of what you just explained. So my mom's birthday, she invited me to go to Vegas with her. She doesn't usually do that. So it just happens that I'm also a neon artist. I run a neon podcast. So it happened to be like the best place to do a whole podcast episode with a person that was our tour guide at the Neon Museum. We did a whole walkthrough of Vegas on our podcast, and we went to go see Donny Osmond with my mom. So like, I know the Donny Osmond ticket is like probably not deductible, but if your interest or your full-time gig is like all, like if it's, I don't know, I guess it's, I don't know if you can answer my question really, but for my purposes, Neon is everywhere. Most of the things I do, I travel for Neon, I do restorations. It kind of, I can really go a long way with like how far that rabbit hole goes. Is there like an end? Like, is there like how much of that research could be deductible, I guess is my question.
Yeah. Oh, Danielle, that's such a good question. Couple things. Happy birthday to your mother. That's amazing. Secondly, there's an amazing neon sign museum in Cincinnati. You should totally check out if you haven't been there yet. But then the real part of your question, I totally agree. Donny Osmond, not deductible. But where I get hung up is on the question, and this is not something, this is maybe rhetorical. Would you have gone to Vegas without your mother's birthday? Right? Because that tells me if the primary purpose really is business related or if it's not. So if your mom were celebrating her birthday in Boise, Idaho, would you have gone to Vegas? Right? So that's kind of how I would make the choice about that primary purpose. Now let's pretend you say, no, primary purpose was, for her birthday, but her birthday celebration was going to be 2 days. We stayed, 3 more days to do the Neon tour, record the podcast, do those extra things. I would be comfortable probably deducting some of those extra travel expenses. But I would also be really careful and prepared to answer those questions. So great question. Thank you for that, Danielle. Karen, question about travel?
Hi, yes. So my main question is travel for a workshop. If I'm a painter and I want to take a weekend workshop. I'm in Delaware, so I want to go to North Carolina. There's several $100s. So that's professional development. Would that be something that, yes, absolutely, that's something that goes on these deductibles?
Absolutely. Yes, 100%.
Okay.
And so the couple $100s to attend the workshop, so like the tuition, that I wouldn't call travel. I'd put that under professional development. But then getting yourself from Delaware to North Carolina, all of that would be travel for sure.
Excellent. Wonderful. Thank you.
Yeah. One more question, Bibi. What's on your mind about travel?
Hi. So I'm like somebody earlier that mentioned that they are just 2021 taxes, and
Totally fine. No shame zone.
Okay. So I'm kind of behind, and right now, like I'm looking at it right now, and I did not keep track of like my mileage or gas. Like I said that I was going to start that this year, but as for 2021, right now they're offering me. I guess my question is, could you break down standard, because they gave me a mileage deduction of $5,000. So I'm trying to figure out what is the standard mileage method that they're talking about.
That is a really good question. And maybe, Bibi, we follow up with that sort of separately, just to kind of see what is informing that standard mileage deduction. Because the normal way we would do it, and maybe for 2021, you go back and sort of you look at your calendar, right? And you say, okay, I did these, 7 events, and then these were the miles, right? Sure. And then you would add up those miles and then multiply it by the rate in 2021. And we're taxing my aging brain right now. It may have been 57.5 cents per business miles driven in 2021, but you can look up that rate, right? And so that rate times what your total miles were would be how you would calculate that for 2021.
Okay, thank you so much.
You're welcome. B. Waldron, I'm going to come back to your question because I'm keeping an eye on the time and I want to make sure we kind of get this. So feel free to leave your hand up. Oh, yeah. Mm-hmm.
And Elaine, if I can jump in, I'll just say we have a lot of questions in the chat. So I just want to ask you this question now. Will you be sharing your contact information at the end of the presentation?
I absolutely will and can. Yes, for sure.
Okay, so folks, if you have a very specific question that seems like a really specific use case, I might not voice that. And I would encourage you to reach out to Elaine directly, just so that we can try to get as many of the questions in the chat so far answered.
Yes, thank you for that. I appreciate it. All right, let's talk about food. So let's say you're on that trip that we just talked about, right? You ate by yourself a whole bunch of times, but then you also had some meetings with other folks, right? Business meals, we would call them, maybe people you wanted to collaborate with in the future. Maybe if you're interviewing somebody for a podcast, you buy them a meal as part of that, right? Then you meet your best friend who happens to live in that city for drinks one night. And then maybe after the trip, you get back home and you're so exhausted, but you go straight to your studio and you DoorDash some food. The question is, are these deductible? And the general rule is, yeah, individual meals while you're in travel status, deductible. Business meals, whether you're traveling or not traveling, yeah, generally deductible. Personal drinks with friends, probably not, even if you're traveling, I wouldn't deduct that. And then in your tax home, DoorDashing food, right? Generally not deductible. Might be a little bit different if it's a team meal or something like that, but the general rule is personal meals while you're at home, even if you need to DoorDash them because you're working really hard, generally not deductible. Your meals go on line 24B on Schedule C. And what we want to do here is make sure we are really clear about documenting the business purpose of the meal. I will also note that during 2021 and 2022, there was a special rule passed by Congress that allowed folks to deduct 100% of the business meals they had in restaurants. That was part of some of the COVID relief legislation because our friends in the hospitality industry were hit really hard during the pandemic. So during 2021 and 2022, there were special rules that allowed you to deduct 100% of your meal cost, as long as it was in a restaurant and still met all of those other characteristics to be deductible. That is going away. So before 2021 and now for 2023 going forward, general rule is meals are 50% deductible. That's 50% deductible. Even if they are ordinary and necessary and not lavish and all of that, still 50% deductible. You may have some people costs as well. This is where I typically see that come up. Let's pretend you are a musician. You're the most responsible person among your bandmates. So whoever is paying for the gig pays you, and then you pay your fellow musicians. That's contract labor. That's deductible. Maybe you hire a couple of interns or students to help you install a show. You pay them $200 a piece, contract labor. And maybe you hire your friend to edit different things you're writing. Also contract labor. All of those things are deductible in general on Schedule C. So if you are hiring someone as an independent contractor, paying them for what they are doing, you are deducting your payments to them on line 11. We always want to document the business purpose. And in my dream record keeping scenario for you, anytime you pay someone, you ask them to fill out a W-9 for you so that at the end of the year, if you have paid them more than $600, you can send them their 1099 because that is your obligation to report their income to them and to the IRS if you pay them more than $600. So kind of keep this in mind anytime you are paying someone you are hiring as a contractor. If you are hiring employees, different scenario, employee wages end up going on line 26. Lydia, I see your hand too, but I'm kind of watching the clock, but I will come back to you. You probably have some creative stuff you need in your business. Maybe it's supplies for a commission. Maybe it is buying materials just as part of your creative practice. And maybe you can track those materials pretty closely, or maybe not. Maybe you're a photographer and you cannot possibly track sort of each piece of sort of photo paper that you print something on, right? In that case, what we're looking at here is are you tracking what we call cost of sales or cost of goods sold? And if you can track the materials with a sale, that's the preferred method. But if you can't, if you say, I'm a jewelry maker, I cannot possibly count sort of all of the different pieces that go into a piece of jewelry I might make, then in that case, we would deduct your creative supplies as materials and supplies. So creative supplies are deductible. Could be a timing issue because cost of sales are only deductible when you sell the thing you have created. But if you can't reasonably track all of your materials and supplies, we expense them immediately and deduct them on line 22 for supplies. Cost of sales sounds really intimidating, but the formula for it on the backside of Schedule C is actually pretty easy to follow. You estimate what you have at the beginning of the year, you add whatever you bought during the year, and then you subtract your estimate of whatever you have at the end of the year. And then that difference becomes your cost of goods sold. Clothing is sometimes controversial. Let's pretend you're invited to give an artist talk and you buy a new outfit. That is probably not deductible because you could probably wear it somewhere else. But if something is not suitable for everyday wear, maybe you're a musician and you have to specially tailor your garment, your performance piece. If you're a violinist, maybe you need more elbow room, right? So you have to specially tailor your performance attire. Then it's not suitable for everyday wear. So it would probably be deductible. Same thing if you're a performer and you have special shoes that you only wear in a performance setting. Or if you have any sort of safety type of garments you wear, all of those are generally deductible. And for this kind of stuff, there's often not a better spot for it on Schedule C. So we have this whole category called other expenses. And if there's something you have that doesn't really fit in a different category, you can put it in this other expenses category and basically name your own category. You see here, I have performance gear and safety equipment, right? So this would be things that are not suitable for everyday wear, and then also specific safety equipment. But remember, the general rule from the IRS is if you can wear it somewhere else, even if you wouldn't, it is generally not deductible. So now we get to research. Research is one of my favorite categories, and we've touched on it a couple of times here, right? So this would be things like attending events or exhibitions. Document that business purpose, right? Maybe you are taking note of trends or investigating certain venues, or maybe you want to work with a producer or a director and you want to see their work, right? Document the business purpose of what you're doing, and then it's probably deductible. Maybe you have different subscriptions to streaming services to keep current on industry trends. That could be research or subscriptions, probably deductible. Certainly, if you're researching a body of work or purchasing books or other materials to support your research, yes, probably deductible. There's could be some overlap here with other categories. I worked with an illustrator who was doing an entire Marie Antoinette piece. So they ended up buying a whole lot of corsets that they were using as reference materials for the illustrations, right? So general rule, garments not deductible, but in this case, the garment is research. And of course, it helps if it is not your size, if you're not photographed ever wearing it, right? If it really is clearly research or reference material. The last one here comes from one of my favorite stories of someone I worked with. They always really dreamed about doing something creative with their favorite sports team, but it was always a dream. So their question to me was, can I deduct all of the tickets to going to games? Because one day I might want to do a painting or write a play or, do something interesting with this sport. And the answer is no, right? It has to be legitimately connected to your body of work, right? Or to something you are actively pursuing. It can't just be dream research that you want to do one day, right? So it's up to you to kind of decide what makes sense and what is legitimate research for your practice and where you're maybe just trying to stretch excessively. Research generally ends up in this other expenses category as well. And again, you want to make sure you are really clear in your record keeping system about the business purpose of the research. You also probably need some non-creative stuff. Maybe you have a newspaper subscription, maybe you have Grammarly, or maybe you use something like Linktree for your Instagram profile. You might have software that you use, right? So all of these other kind of non-creative expenses are generally deductible as well. I will say something around Spotify. If Spotify is part of your research, you're a musician, you use it to review repertoire for upcoming shows, I could see a portion of your Spotify being deductible. Probably not the whole thing, let's be honest, but maybe a portion of it. The same is true if you're a visual artist and you use it in your work in some way. So there could be a case for business use of something like Spotify. But if you just work best when there's music on, that's not going to be enough to deduct your Spotify subscription. So again, just kind of use your best judgment here about, is it really ordinary, necessary, and effectively connected to my trade or business? And how can I articulate that? Subscriptions and software often also end up in this other expenses category, although maybe it makes more sense for you to put something like Linktree in an advertising category on Schedule C. That's fine if you use it for advertising purposes. Just be consistent year to year with what category you're using. Same thing, I've also seen people use Office software subscriptions in the Office expenses category because that feels best for their work. Totally fine. Just be consistent year after year. Now, this gets back to one of the questions that came up earlier about education costs that may be deductible. The general rule is if it is professional development, master classes, maybe Skillshare, paying to attend a workshop on entrepreneurship or business practices or marketing, all of that feels like professional development related to your current industry, and that is generally deductible. If it is education in pursuit of a degree, that is not deductible, right? That is personal education expenses. And there might be tax credits that could help you on your personal tax return, but that's not going to be deducted from a business perspective. I think, though, there is some latitude here, right? Weekly improv class, for some people, that might just be for fun. For you, if your business purpose is to improve your public speaking, especially in preparation for, say, an artist talk you're giving, right? I could see a business purpose associated with that. Personal development generally doesn't include personal counseling or mental health support. Generally speaking, that is a personal expense and not deductible. Professional development usually also lives in this other expenses category. And as always, we want to document the business purpose of that professional development. Now, here's something that comes up all the time. And the question is, can you deduct donations of your work? So let's pretend you're a visual artist. You made a piece. You maybe had $175 in material costs, and then you donated it to some organization. They ended up auctioning it for $1,800, and you normally would have sold it for about $1,000. In this case, $175 is the amount that you are allowed to deduct for your donation, right? Because you're essentially deducting the cost of the thing that you are no longer able to sell. Similarly, if you're a performing artist, maybe you're asked to perform for free, but you cannot deduct your normal fee as a donation of what you would have given them, right? Because labor costs are not deductible as donations. But if you had to transport yourself or your instrument or your bandmates, or maybe dry clean your attire, I could see deductions for those expenses. Lastly, maybe you're a literary artist and you are asked to donate copies of your book. The amount that you would deduct is the cost of the book as opposed to the retail price of the book. So donations get really tricky here because you essentially are only allowed to deduct the cost of what you are contributing. Megan, questions about donations?
Sorry, I was trying to unmute. Yes. I was told that we have to pay, you can deduct that expense amount, but you have to pay the tax on it in your retail tax when you submit your retail tax.
That does not feel accurate to me, because like, let's say I'm going to take this sort of first example, the painting, right? You're not getting that $1,800.
Right.
So that's not subject to sales tax or gross receipts tax or retail
Right.
tax, depending on where you
Well,
are.
I
So
had our state office called me, and because I sell on Etsy, and they said the customer already pays the resale tax on Etsy, so I don't have to pay that again. But they said any donated work, or if I purchase a frame for it, I have to pay tax on the frame and the item donated. And I'm like, well, that's kind of crappy.
yeah, well, if you buy the frame,
Maybe I misunderstood what they were saying. Well,
could be, but I also, there might be extra nuance here, right? So
okay.
buy the frame if
Yes.
you have a sales tax exemption certificate,
I
because
do.
when you sell the thing, you're
Yes.
collecting the sales tax, or Etsy is, right?
Yes.
I think if you're buying the frame for something that is then donated, you can't use your exemption to not pay sales tax when you buy
Right.
it. So that
Right.
might be sort of the nuance there.
Okay. But there's but if I donate something, it's just a matter of donating the supplies on it is the big thing.
Exactly. You basically deduct this cost of sales of the
Okay.
thing. But when you're reporting your sales to your state, there's no sales there that you would repeat.
Okay. And then like if the charity sends you like a tax form of how much it's sold for, then, but that's not used, it's just the supply, it goes back to just the supplies.
Correct.
Okay.
Yep,
Okay.
exactly. Hey, Karanda.
Oh,
Hey there, Elaine. I know you're going to be moving into questions about home, and we do have quite a few about that. And I presume you'll be talking about homes, and then maybe if you're buying groceries while you're there. But I just want to say that we at South Arts know we currently have about 4 pages of questions that have come through the chat, and we want to be mindful of giving tax advice and also legal advice. So we are going to work with Elaine after this session to see if we can provide some sort of high-level FAQ for folks. So just remember, if you have specific situations or nuances, we would encourage you to, speak with a CPA so that you can get a more complete answer. But we are going to see if we can create some sort of cheat sheet that will be sent out to participants. It will not be posted on our website. So with that being said, I do have one question, Elaine, that I'm just curious to know if you can answer while we're talking about Schedule C. If someone is filing a 990N, do they need to do a Schedule C?
No, because Schedule C is for a business you are running. If you're filing a 990N, you are a nonprofit, right? A relatively small charity. I forget what the cutoff of gross receipts is, but 990 is for a nonprofit you are running that is overseen by a board of directors. So totally different than a business you are running. So definitely 990, totally different from Schedule C. Great question and clarification. And I love the idea of an FAQ because there are a lot of questions, right? There's a lot of nuance here. So let's talk about home office or business use of your home, because this comes up all the time. And this is an area of scrutiny for the IRS. This is what it often looks like. Maybe you have a separate room that you use as a studio. Maybe you use it as a studio, but you also work from home for your W-2 job. Remember at the very beginning, no deductions for W-2 job, right? We want to be careful about that overlap. And maybe you've got a separate space, but your partner also works from home and has some of that space as well, right? So lots of different ways this could come up. Here's the general rule. You may deduct the business use of your home if the space is used exclusively, that's a big one, and regularly for your business purpose. So if the space is exclusively a recording studio where you practice or perform, where you make work, right? All of that feels like exclusive use. But if it's also your kitchen table or a guest room or a kid's playroom, that is not exclusive use of the space, right? So you have to be really clear on the rule to make sure you are identifying the space within your home that is used exclusively and regularly for your business purpose. It has to be your principal place of business. You can't have any other spaces that you use. So let's pretend you have a studio and sometimes you also work from home, right? Nope, you got to deduct the studio space, and then business use of your home is just for you, which is nice, but it's not deductible. This is one of those areas where you want to absolutely put in the time to accurately track the business use of your home. The way we usually see this is you will have a copy of your floor plan and indicate the space that is used exclusively and regularly for your business. In this first example, it's 100 square feet out of 1,000 square feet, so 10% of the space. And then you would deduct 10% of your rent or mortgage, probably 10% of your utilities, right? So you can see this could be a lucrative deduction, which is why the IRS scrutinizes it so carefully, right? This is down on line 30. It's on its own place on Schedule C, and it is allowed, but you want to make sure you are complying with kind of the letter of the law on these. I have a moment here to check in with Karanda, but since we're going to do an FAQ later, I'm going to come back to that while I end with a couple of other highlights I want to make sure you know. As you've calculated the net income from your business, whatever you've brought in minus your ordinary and necessary business deductions, that gives you your net profit. This amount goes two places on your tax return. The first place it goes is on the form where you calculate your self-employment tax. That's that 15.3% of your Social Security and Medicare that you pay. Then this number also gets added to any other income you might have from your business, right? So let's pretend you got a grant in 2022. Let's say it was a $10,000 grant. The funder awarded you the money. You had submitted a budget. You're going to spend, say, $6,000 on supplies, maybe $1,000 on contract labor, and then $3,000 of the grant is going to be your own honorarium. If you were reporting that, the grant is taxable income to you. So you would report that $10,000, then you would deduct the contract labor and the supplies for $7,000. So this net amount, $3,000, ends up being your honorarium, and that is the amount that is subject to self-employment tax. Remember, any income you receive is generally taxable income. And the tax you pay on that business income, part of the tax you pay on that business income, is on the net profit from the business, right? So again, these records become really important to make sure, A, you're planning for this tax, and B, you're accurately calculating what this net profit amount is. Here's an example. If you want to see some numbers around this person earns $50,000 in their business, has $15,000 of deductions. Their self-employment tax ends up being $5,355, right? But that's not all the tax they pay. They also have to pay income tax on that. And in income tax world, the general rule is that personal expenses are not deductible. But your income tax return does allow for some adjustments which allow you to reduce your income for other deductions that might feel more personal in nature. The first one is the deductible half of your self-employment tax, right? So that helps a little bit. You get a deduction for half of this tax you have to pay. But if you are someone who is making student loan payments, the interest on those student loans is generally deductible as an adjustment to your income on Schedule 1. And if you're making retirement contributions, those retirement contributions generally count as tax deductions for you as well, which is really nice. If you have a traditional IRA, that deduction shows up here on line 20. If you have a different type of retirement plan, maybe a SEP IRA, maybe you have a solo 401k for your business, those contributions are deductible as well, and they show up as these adjustments to income. But those are totally different from your standard deduction amount, right? There's so much here, and this is why taxes drive people crazy, right? Because we've talked about business deductions. We've talked about some of those personal adjustments that count as deductions. And now we're talking about the standard deduction. The standard deduction is an amount that every taxpayer gets based on their filing status. So if you are legally married and filing jointly with your spouse, your standard deduction amount is $25,900. That reduces your taxable income. You still have that self-employment tax you've paid, but it reduces the taxable income you have that's subject to income tax. But there's one more slight complication here. You may have heard of something called itemizing your deductions. If you itemize your deductions, you're basically looking at something called Schedule A. And Schedule A lists a whole lot of things that are itemized deductions. The most common ones are state and local taxes, interest you pay on your home mortgage, and charitable contributions you might make. These have to be to qualified charities. They can't be to sort of GoFundMe accounts for someone or something like that. It has to be a qualified charity. But what we do is we look at things on this schedule, and if your expenses on this schedule add up to more than your standard deduction amount, you would want to itemize your deductions. So let's pretend you live in a very high tax jurisdiction. Maybe you're based in New York, you're based in Massachusetts, right? Your state and local taxes, the deduction is capped at $10,000, but if you live somewhere with high taxes, you're probably paying that. And let's say you make a really generous contribution to your favorite arts organization. Maybe it's a $5,000 contribution. $10,000 in state and local taxes plus $5,000 in charitable contributions is $15,000. That's going to be more than your standard deduction amount if you are a single taxpayer, so you would choose to itemize. Itemizing or taking the standard deduction is an either or choice. You take one or the other, whichever one is bigger. And your business deductions go on top of that, right? Because remember, your business deductions live on Schedule C. You get ordinary and necessary business deductions if you are running a business. So sometimes folks will say, oh, I don't track my business expenses because I don't itemize. And this just breaks my heart because those are two different things, right? Standard deduction or itemizing your deduction. Everybody gets one or the other. And if you are running a business, all of your business deductions are reported over here on Schedule C. So you get these in addition to one or the other of those. So you've got your income, you've got the net income from your business, you've adjusted it maybe for an IRA contribution, you've taken the standard deduction. Then we calculate your income tax. We have a progressive tax rate system in the United States, meaning the first $10,275 of everybody's taxable income is taxed at 10%. Then the next layer of taxable income is at 12%, and then the rates go up from there. Here's an example from that artist we had earlier, right? Remember, they had $35,000 of net business income. Let's say they had an IRA contribution and the standard deduction. That gets to their taxable income number right here. And then we calculate their tax. 10% on the first $10,275, 12% on the next $6,098. Then their income tax for federal purposes is $1,760. But remember, that gets added to that self-employment tax. And again, this is the piece that folks often forget about. And it's big, right? There's no standard deduction there, just business deductions, right? So now this person is looking at $7,100 or so in taxes. But then they probably live in a state that imposes income taxes, and they might even live in a city that imposes income taxes as well. So we would want to make sure to add in those taxes. Different forms, right? They go to different taxing jurisdictions, but this person might end up looking at about $8,200, $8,300 of taxes, right? So you can see this adds up pretty quickly. So if they're bringing in after business expenses, $35,000, $8,000 of taxes is a big share of that. Once you know the tax you're going to owe, then we subtract anything you paid in during the year. So maybe those are withholdings from a W-2 job you have, right? Because those withholdings can go toward your overall tax obligation. Or maybe you are someone who is making those quarterly estimated federal tax payments, right? If you're going to owe $8,261, maybe you paid in, say, $2,000 a quarter, right? So then all of a sudden, right, you are essentially prepaying your tax throughout the year. And then the difference between what your actual tax is and what you paid in during the year is a refund if you paid in too much, or extra tax you owe if you didn't pay in enough. I was saying earlier about that $1,000, if you end up owing $1,000 or more when you file your tax return, that is generally the moment where your tax software system or your CPA will say, hey, you need to start making quarterly estimated payments, because if you're going to owe $1,000 or more, you'll get hit with penalties. Karanda, yeah, what's on your mind?
Hey there. So I just wanted to go back to the state and local slide or just to reference this. And if someone had income from different states, this is a case where you would make filings for multiple states and not just your home state. Is that correct?
Great question, Karanda. It depends. And I hate that answer. So apologies, but it depends. Let's pretend your tax home is in Georgia. That is where you are based. That is where your business is based, right? You only have to pay income taxes to other states if you exist there for tax purposes, right? So if you also own property in South Carolina, and maybe that's where your studio is, yeah, you're probably looking at paying income taxes in multiple states. Although usually states are pretty nice about giving you credits for taxes you pay to other states, so you don't end up getting taxed twice. But let's pretend you're based in Georgia and you just happen to go to South Carolina for a show for like a weekend or something. That is generally not enough to make you exist in South Carolina for tax purposes. So in that case, your income is still Georgia income. Now, if you're a performing artist or if you're someone who's spending extended amounts of time in different states, you'll want to look up what the rules say. For example, I just happen to know that in New York, if you are there for 183 days or more, you are subject to New York income tax. So let's pretend maybe you're a director and you have a long-term gig in New York. Your tax home might still be in Georgia, but you might be paying New York income taxes because you are there for a certain number of days that exceeds the amount that requires you to pay income taxes in New York. Every state can define this differently in their own way. But if you move during the year, that's often when you have to file in multiple states. Or if you exist for tax purposes in multiple states, then you'll be filing for multiple jurisdictions. But one extra point of clarification, remember, this is all about income taxes. If you're talking about sales taxes, that's a little bit different, right? Because the sales tax rules are different than the income tax rules, which is supremely annoying. And I apologize just on behalf of all tax people, right? Because it's really, really complicated. But the general rule is file in your tax home, right? And pay your income taxes there. And then if you're spending more time or extended periods of time somewhere else, or if you're moving somewhere else, you definitely might find yourself paying taxes in multiple places. So that's kind of part of this planning conversation too, right? If you are just starting out, The general suggestion I would have, or my invitation to you would be, every time you are paid, set aside 30% of what you are paid as a freelancer or contractor or business owner for taxes. You may not end up needing all of that. And in fact, I hope you don't, but it'll be really nice to have that money there. And if you're saying, oh my gosh, Elaine, there's no way I can do that and still pay for my expenses, you probably need to be charging more money because taxes are part of your business, right? If you have a W-2 job, you can also adjust your withholdings from that job to withhold extra dollars to help cover those taxes, even from your business. So let's pretend, in addition to running your business, you have a part-time W-2 job. Instead of just the regular withholdings, you can fill out the later part of W-4 and basically say, hey, I'm going to have, $30,000 extra of income. Would you adjust my withholdings? And then your HR person or your payroll person can adjust the withholdings to help cover that tax obligation. It's still your money, right? But you're using the infrastructure of your employer in a way that might really help. I will also say the IRS has a tax withholding estimator tool. It's really good. It is very detailed and it takes a long time to complete, but it's really accurate. So if you are someone with multiple W-2 jobs or you're not totally sure about what your taxes might be, this is a really good way to estimate what they might be under different scenarios. And give yourself plenty of time to fill this out. It's not like a 5-minute exercise because they will ask you a lot of questions. But let's say you're not just starting out, you've been doing this for a while, right? If you've got some experience, you want to do a more diligent estimate of your self-employment and income taxes. You're probably looking at prior year tax returns, maybe you're working with your CPA, and that way you can say, okay, my number isn't 30% to set aside, I need to set aside 28% or 34% or whatever it is, right? You can use the data you've gathered to do a little bit more concrete planning. So with that, as we are approaching the end of our time together, I want to just recap. We talked about a whole lot today. Thank you for hanging out with me for 90 minutes to talk about taxes, overall tax landscape for income tax purposes, ordinary and necessary business expenses with a whole lot more follow-up questions to come. Stay tuned. And then we talked a whole lot about record-keeping systems. So Megan, you have had your hand up for so long. Thank you for your patience while I got back to this. What's your question, Megan? Nope, never mind. Lydia, what's your question? Thanks for re-upping it. I know I saw you earlier. I appreciate your patience.
Hi, Elaine. Thank you. My question is, so if I hired 2 artistic collaborators and paid for their airfare, would that be a payment made to the artist, or does that count as a travel expenses?
Great question. Travel expenses. And just note kind of in your record keeping system, you would have airfare for Lydia, airfare for collaborator 1, airfare for collaborator 2. And I would name them.
Great. Thank you so much.
Of course. Great question. B. Waldron, you've had your hand up for a really long time too. What's your question?
Sure. Thank you so much. So the first part, I think you already answered, which was fellowship money. If they paid your travel, everything like that, your answer was yes, we can deduct all of that, even though it was money incoming money. And my second part is, in your experience, do you think that it's worth just in your beginning years, just getting a CPA? Because even though, maybe you're not making a lot of money, 25, 5,000, 6,000, I'm getting mixed reviews on whether I should just do it myself in those first 4 years before I hand it over, or it's not worth it, get a CPA now and then dump all that information, let them do it.
Yes.
So what would your suggestion be?
Oh, such a good question. I say this as a CPA who does not prepare tax returns. CPAs add a lot of value, right? Because they can do a whole lot of planning things for you. The value of those planning things tend to kick in after there's more dollars involved, right? So in the early years, you may want to not hire a CPA, but hire, say, a tax preparer. Sometimes we might see an enrolled agent or a tax preparer with expertise in the arts. That might be a little bit more cost effective early on. They don't generally do planning or strategies around taxes, but it's more affordable and accessible. And that planning piece might be really helpful down the line. Having said that, I think the absolute best way to get clarity around what you need from a CPA is to have a couple of years of doing this yourself. So for me, the question kind of comes down to, do you have about 6 hours in the spring that you want to devote to doing your own taxes? Because it's probably going to be 6 hours on top of all the record keeping. And if you say, yes, Elaine, that sounds amazing. I'd love to do that on a Saturday in March with March Madness basketball on in the background, I would say do it yourself. You'll learn a lot and you'll have a better idea of what you might need from a partner in the future. If you say to me, Elaine, spring is my busiest season, I could actually be making money from my art instead of doing my taxes, I think it's a much smarter choice to invest the money in letting someone else do it. I hope that's helpful.
That's excellent advice. Thank you so much.
You're welcome. Lee, what's on your mind?
I just had a quick question going back to our donation and what you can claim. If I work with found wood, so my materials are nothing. Is there any way that I can, like, I get asked for donations all the time. Is there any way that I can claim anything for those donations if my materials are found?
I mean, no is sort of where I'm landing.
Yeah, yeah.
Which then sort of begs the question, what are you getting out of it, right? So
Absolutely.
Sometimes we do it out of the goodness of our heart, but I'd much rather you donate a piece and then get a list of everyone who bid on that piece so that you can follow up with them, invite them to do a studio visit, maybe buy something else, right? So I think, no, you're probably not looking at any sort of tax benefit there, but there's probably some other strategic benefit that you could lean into.
Gorgeous. Thanks, Elaine.
You're welcome. Bibi, what's on your mind?
Hi. Okay. I was wondering about, and you covered it, but I think I just got a little confused. So is performing, like, because I'm a performing artist, actor. So I'm trying to figure out, does that count as a qualified business income? Like,
yeah, if you are in the business of being a performer, yes, right? So let's say you are regularly hired for acting gigs, voiceover gigs, production work. Yeah, totally there. If I occasionally am hired for $100 to go and like read something at a school, that's not going to be business income to me because I'm not in the business of reading things at schools, right? But if you are generally actively conducting this business, yeah, that's business income to you. Unless you're the kind of actor that's paid as an equity actor as W-2 income, then it's W-2 income, business income.
Gotcha. Thank you so much.
Yeah. I see a couple of things in the chat that are timely. So I just want to call those out really quick. PayPal, Venmo, all those sort of online payments you might be receiving. So 2 things to know. Number one, that is taxable income to you, right? If you are in the business of selling things, you accept Venmo payments or whatever, right? That is business income to you. So you should be reporting that minus any fees, minus sort of any other expenses. You may have been expecting to get a very special new 1099 from Venmo or PayPal this year. The reporting threshold change has been delayed a year. So you probably won't get your 1099K from these companies, right? But that's still business income to you. Now, if you are someone who uses Venmo for personal purposes, you want to make sure a personal transaction is not marked as goods and services, because that transaction then is going to trigger that future 1099K reporting. And if a friend is Venmoing you money for dinner, that's not business income. So just make sure and watch your Venmo, right? Communicate to your friends that that should not be tracked as goods or service income. If you want to set up like a separate Venmo or PayPal, one for business, one for personal, I love that as a strategy, right? There are fees associated with the business one, but you are running a business and approaching it professionally. And sometimes that means paying for your fees. And then follow up, what if it is all kind of mixed together? That means your job is to go through that transaction history and sort out what is business income and what is personal. And know that, especially with Venmo, if it's categorized incorrectly, right? If someone says it's goods and services, even if it's personal, that's going to mess up your 1099K in future years. So if there's an error on your 1099K, you have to then go back to PayPal or Venmo and say, hey, there's a mistake. Can we fix it? And that is super annoying. So since we have an extra year before that reporting threshold change, I would say do your best to go ahead and keep everything sort of clean and organized going forward. Great, great, great questions. Deanna, what's your question?
I just had just a quick question. Is it just best to set up your business under a FEIN number? That's the first one. And the second one is about the sales tax. If a person does like a print on demand, I did catch a little bit of what the young lady said about Etsy. They don't have to worry about paying that, or I'm not too clear on that. Yeah. I actually set up a business 2 years ago and I had to shut it down because my tax accountant didn't know what was going on with the taxes. And I'm kind of a real honest person with my taxes. I'd rather pay money to the government than them hounding my back for something. So I just shut it down.
Yeah.
It's been 3 years now.
Yeah. So an EIN, a federal employer identification number, can be really helpful if you do not want to share your social security number. If you're doing like a lot of freelance gigs or 1099 gigs, having an EIN could be helpful. So it's more like a security protection thing. Or if you are forming a limited liability company, then you have to have that EIN. But a lot of people just use their social security number and don't worry about it. And when it comes to sales tax, investigate the platform you're working with, right? I think earlier you mentioned Zazzle and Redbubble, maybe Shopify, right? Just like with Etsy, those different platforms will tell you if they are handling the sales tax for print on demand or if not. The general rule is generally they are handling that since they're handling the transaction, but it's a good idea to check. Such good questions. Yeah, Kevin, what's on your mind? Kevin, got your question? Yeah. Sorry, we can't hear you. I'm sorry, I'm going to go to someone else, but feel free to just drop it in the chat and we'll get to it in the FAQs if we don't get to it quickly. Becky, yeah.
Okay, I did ask in the chat, but most of the direction you've been going with everything is for people that are artists, and I'm not an artist. I just run an arts organization, but I do it from my home. And I think you said because I'm a W-2 employee, you can't deduct things. Is that correct?
That's correct. Sorry.
That's most unfortunate.
Your arts organization should pay you more to help cover those expenses that they are
to rent. I have to write grants for my own salary, so that just be on me too.
Yeah, but if you're a W-2 employee, no deductions, no deductions. I'm seeing a little bit more chatter in the chat around this PayPal Venmo thing, right? The big deal is the 1099. So up until like end of December, they were going to be sending 1099s to anyone who had business transactions on those platforms, right? And for Venmo, the way you indicate a business transaction is the purchaser checks that goods and services box, right? That reporting threshold change has been pushed back a year. So you won't get a 1099 for 2022. But remember, that is business income to you for sure. So, so definitely kind of make sure you are capturing that. I know we still have some questions. I do want to be so respectful of everyone's time then, because we are already 9 minutes over and you have already given me 90 minutes of your time today to talk about taxes, which is a lot. So you have well earned lunch or a coffee break or a cookie break or whatever affirmation feels best for you. I will end with gratitude. I am so thankful for you, for your existence in the world, for all of your amazing engagement and questions, and most of all, grateful to the team at South Arts who facilitated this. Jessica, Emmett, Karanda for facilitating the questions and working with me to sort of do that follow-up. So thank you all. Jessica, I'm going to turn it back over to you.
Thank you so much, Elaine. It just shows how much of an interest there is in this topic, how much more information could be out there. I know some of you had some questions about, could we find artist-friendly CPAs? I hope so. We will definitely be on the lookout for that. I want to just do a quick plug for some arts advocacy here. These tax laws and policies and things like that are monitored often by, organizations that work in advocacy. So if it is something that you feel very passionate about, start researching your local advocacy groups, your state arts advocacies, or even at a city level advocacy group. Get involved with them. These things really matter and they affect your livelihood. So please, I'm just imploring you to get involved in arts advocacy, because these are the kinds of things that we never really hear about, but affect our everyday lives. And so I just want to put that out there. Emmett, do you have anything that you want to add or chime into before we say goodbye?
I do not. I thank everyone for the active participation. There is a part 2 on the way, and we are also planning other developmental, financial, legal types of workshops to be in service to you. So thank you so much for your participation.
Thank you, everyone. And again, thank you to the National Endowment for the Arts for helping to support this program. Thank you to Elaine. Thank you, Karanda, for your amazing support. And thank you, Emmett, for your collaboration. And everyone, enjoy the rest of your day. Stay warm, stay healthy, and goodbye.